little bit about myself. Firstly, for those of you who perhaps don't know me, I started here in January. Prior to that, I was at Fonterra. I was the GM of Trading Among Farmers there. I joined there 3 years ago. I was responsible for much of the technical design and implementation of TAF. So in that, I dealt with sort of very much the major participants in the New Zealand market, that being share registries, brokers, investment banks, of course Fonterra shareholders all around the country as well. So I have a reasonable view of being in many parts of the market here in New Zealand. And prior to that, I worked at E-Trade in Sydney. I was the head of wholesale broking there, so I know what it's sort of like to try and run a small broking business in the middle of the GFC. And prior to that, I was a CIO. So I actually predominantly come from a technology background in financial services. 10 years prior to that, I also worked with ANZ when they bought the National Bank here in New Zealand. So my history in actually New Zealand goes back a decade or so. So I think in terms of my role here, I think that background means I do have some technology experience, the experience on the issuer side as well. As post Fonterra's launch of the shareholders fund, I was responsible for the issuer responsibilities that go along with that. So I understand what it means for a new company to be listed and the challenges that go along with that. And I understand from a broking point of view, challenges of trying to get investors to invest in direct equities. So hopefully, therefore, I bring some value to the team here. In terms of what I was going to cover off today, I'll talk a little bit around what we describe as the supply-demand mismatch in the capital markets. I'll talk about our 3 areas of focus in this particular team this year, of what we're spending all our time on, including equity derivatives, which I'll touch on later. And then also I'll give you a bit of a flavour for the longer term roadmap. So really everything I'm talking about today is stuff we're executing this year. Much of it will take a number of years to pay off, but it's really our 12-month execution time frame. However, our sort of roadmap for development goes out for many years past that. The one takeaway from all of that is our ability to execute all of these initiatives is based on what's in the team now. The growth we see, particularly in the dairy derivatives and the smart shares space, could be done within existing headcount and existing spend. So the payoff or the benefit of those particular businesses that with growth does not come incremental cost growth. Tim sort of touched on this briefly, but just to give you a view of what's happened here in the New Zealand capital markets over the last 10 years. The yellow and grey lines really demonstrate our market cap being yellow and the turnover being grey. And that's what really drives our revenue in the capital markets team. Roughly 60% of our revenue is to do with market cap, 40% to do with turnover. And you can see that both market cap and turnover are strongly correlated to an increase in IPO activity. So when we saw the GFC through 2008, for the next 4 to 5 years, you saw IPO activity there virtually grinding to a halt. And then in late 2012, we saw the launch of the Fonterra Shareholders Fund leading into the MOM program last year. We see an uptick in market cap and corresponding uptick in turnover. So they all go well for the capital markets team, and we see through the IPO pipeline ahead that will continue for the foreseeable future. We're quite bullish in this particular market. I talked at the start there about what we see as the supply and demand mismatch, and what I mean by that is in regards to supply, is the number of investment opportunities that exist, or the supply of investment opportunities that exist for New Zealand equities investors. In this chart, please don't, I appreciate you won't be able to read it up the back, I'll describe it briefly to you. This is how we try and compare ourselves to global peers on our capital market. So what you're seeing here, the vertical axis is actually the critical one in this particular chart, is market cap as a percentage of GDP. So that is the value of our listed companies as a percentage of the value of our national economy. And New Zealand back in 2011 was sitting at about 29%. That is 29% of the value of GDP is represented by a market cap of our listed entities. Now, we often compare ourselves against Australia with many of our sort of financial matrices. In this case, we don't, and I'll talk to you a little bit around that in a minute, why that's the case. That's Australia up here. We compare ourselves in this particular chart or statistic against Israel, Finland, Denmark and Belgium, these ones here. And the reason for that is they have a similar GDP per capita to us. They have similar population, similar size economies. So we compare ourselves to those. And at the moment we're lagging those, and I'll touch on that next. The reason why we don't necessarily compare ourselves to Australia in this particular statistic is Australia just has a far greater large number of listed issuers that we will never have here. So to paint that picture, the biggest company in Australia, BHP, is $200 billion. It's roughly 2.5 times our entire New Zealand market by itself. In fact, all the top 10 listed companies in Australia are all bigger than our entire New Zealand market. So we don't have any BHPs on the shelf here that are not yet listed. So therefore, we don't think it's appropriate. What we have here in terms of the supply side is a lot of small to medium-sized enterprises, a really burgeoning tech sector that we think are going to help fill this supply shortfall. And I'll talk a little bit how we think we're going to address that with the growth market later on. Just in terms of this slide, the left chart really is showing the picture I just talked about when we're comparing ourselves to Belgium, Denmark, Finland and Israel. For us to catch up with that supply gap, if you like, we have to find about $54 billion worth of companies that are prepared to list. That's about 5 Fonterras, not just the fund, it's the full Fonterra, or about 540 odd snack medias as an example. So it's a reasonable number, big job ahead of us, not saying we're shying away from it, but there's a big opportunity for us here. Once again, just to use perhaps an Australian comparison, not necessarily on market cap, but just in terms of companies. In New Zealand, of the top 100 companies in New Zealand, we think roughly low 30s are publicly traded. In Australia, we think that's mid-60s. That is, big companies that are validly invested in by the general public. Now, some changes under the Financial Markets Conduct Act we think make some benefits to this, both with us able to launch new markets, but also with changes that allow companies to more easily tap capital markets once they're already listed, make it easier to do subsequent issuances, both for equity and for debt. So we see some benefits there for us moving forward. Now, so that's the supply side. On the demand side, where we see is a significant growth in KiwiSaver, and Tim's touched on this, and no doubt this will not be a surprise to any of you either. On the chart on the left is really the one worth looking at. This is trying to map indexed for the start of KiwiSaver back in 2008 against Australian superannuation starting in 88. So we're trying to index what the growth profile of KiwiSaver might be. And in the first 6 years of that, you'll see it's actually tracking very, very similar. Despite, however, of course, us not having a mandated employer responsibility like there is in Australia. It's about to move from 9 to 12%. Here, however, we're still expecting 11%. This is a conservative 11% compound growth rate in terms of KiwiSaver funds. So when we look at that supply mismatch once before, we're seeing a lack of New Zealand companies that we as New Zealand investors can invest in, yet we've got sort of a wall of money coming in that's looking for a home to be invested in. So this is the supply-demand mismatch we talk about today. That's why we see the real opportunity with, firstly, the growth market, being able to help small to medium-sized companies come to market, providing more product on the shelf, as Tim sometimes alludes to it. And also we expect to see growth in smart shares, which is our passive funds business. A couple of changes to how our fee structure works in the capital market space briefly. Last year we changed our fee structure for some of our larger issuers, where we aligned our fees more with market cap as opposed to just trading revenue. So the benefit of that obviously is when we see market cap growth, which we've seen of late. Going ahead, we didn't do any changes last year to our smaller issuers. That was focused on larger issuers. and that was actually capped as well. This year, we will look at our smaller issuers. The reason being we think we're adding increased value in this space. We're going to further develop NZX.com, which is our online retail or online sort of information channel. I'll talk about it a minute later. We're going to do more investor roadshows for smaller businesses this year. We expect to see an increased investor engagement. And last year, and we expect to continue this, we've also trialled research for some smaller businesses. So we think we'd like to be able to demonstrate to our smaller issuers we are increasing value, but we will be looking at fee structure for them this year. So NZX.com, we see this as a valuable channel, yet we actually don't derive any revenue from it. So what you're looking at there is traffic on NZX.com as it exists now. We actually have about half a dozen different websites at the NZX, which all have different jobs. NZX.com is the primary channel people will go to get quotes, get news. You'll see videos, etc. on there. For those of you who perhaps do more in-depth company research, you'll go to our CRC platform. For those of you who perhaps work in the listed issuer side of your business, you'd go to our MAP platform, which is an announcement platform. And if you're a fund manager, you may go to our fund source business, which has statistics on all the major funds in New Zealand. So we actually have a number of different online platforms, NZX.com being the main one. And you can see there we tend to get over 100,000 unique visitors a month. So it's actually reasonable traffic to this website. So we'll be looking at growing what we provide on this website, including some basic IR functionality for listed issuers, directors database, as well as a virtual trading platform. The virtual trading platform the idea is actually to help with investor literacy here in New Zealand. So we'd expect that to be predominantly used by high schools and universities. The idea being this is very much a slow burn, but bringing investor literacy in at a younger age so that when at an age where they're ready to invest, they can do so with confidence. So that's very much an element we're trying to play on there. Now the benefit we see of actually creating a better NZX.com platform is something that people are more attracted to go to and see the benefits of going to, is we can increase sponsorship and also potentially subscription revenue on there. One of sort of the areas Tim asked me to look at in particular when I joined was IPO pipeline, or how we manage the listing process and how we get in front of businesses to try and extol the virtues of listing and where they could benefit their businesses. So this just to give you an idea of what's going on in the pipeline at the moment and how we manage it. These are sort of the 6 steps, if you like, major steps a company would move through from being initially contacted to perhaps initially thinking about it through to listing. And you can see the numbers there of roughly that we currently see in each one of those categories. And then we'll prioritise these, well, not necessarily prioritise, but we'll segment these companies based on the type of company they are. As an example, could be the size of company, whether or not they're already equally widely held, or whether or not they're a small family-owned business, whether or not they're perhaps a co-op, etc. And then where they're likely to end up, so whether they're likely to end up on the main board, the AX, or going forward our new growth market, which I'll touch on at the moment. Now this sort of is focused on equity, but the same pipeline applies to debt as where we talk to these businesses. But this year, as an example, just in one-on-one contacts between Tim, myself, John at the back of the room, we would have done well over 30 face-to-face contacts with businesses looking to list this year. Certainly, market is taking our calls at the moment, if you like, in this particular space. Just on the other part under documents received, this doesn't sit in the capital markets team, this sits in the regulation team, but something to be aware of here in particular is although quality control is done by the regulation team, it's very much independent of mine, which is more the commercial arm of NZX. It's augmented by the CEO's capability to decline a listing based on commercial reasons as well. So they'll look at it from a regulatory point of view, does it meet the rules? But the CEO has the ability to decline a listing if they feel it's based on commercial reasons as well. Just to give you an example of how revenue is derived from a listing, this is using Synlay as an example. If you're looking at the left-hand chart, you'll see very typically of an IPO, huge trading spike immediately after launch. which is the vertical sort of down here, and then it'll eventually settle down, and then you'll occasionally get sort of liquidity spikes depending on what sort of liquidity events were happening. Now, the benefit to us from a revenue point of view is the top half of the table here. So an initial listing fee is the top line, happens when they originally IPO, and then the second line there is that activity in the first month when you see a real increase in, or a real jump in trading activity until it starts to tail off. And then below that line, what you're looking at is the ongoing revenue. So ongoing revenue, you'll see there, tends to represent sort of somewhere around 50% of the initial revenue. So actually ongoing revenue is actually very, very positive for these businesses. And as I talked about before, revenues derive both from market cap and trading. So the bigger the company gets and the more liquid it gets, the better it is from us from a revenue point of view. Equally for those companies, that's something they're striving for as well, right? They want to increase their market cap over time for the benefit of their shareholders, and certainly liquidity is something they would generally measure themselves as well. So we actually have a vested interest with our issuers in that case. Onto the growth market. We've described the growth market as a sort of stepping stone market between some different sources of private funding and the main board here in New Zealand. And this is trying to describe between perhaps the initial angel or venture capital up here and the main board here. We're talking about the growth market here. So firstly, we don't necessarily see these other sources of capital as competitors to this market. We see this market as largely complementary. So what I'm talking about with angel, venture capital, private equity in particular is they do have a function in our market. Where we see competing against private equity in particular is once companies reach a particular size, where we'll often speak to a company and what we're up against when we're trying to list them is that they might have a trade deal or a trade sale is something we're competing against. So that's where we tend to find we're competing. In terms of smaller businesses, initially trying to get a sponsorship for an idea they have or some research and development, we don't see ourselves competing in that space. Generally speaking, once an idea has reached some level of commercialisation, then we think we've got a real benefit to add to those companies if they want to maintain strength of ownership of their businesses, yet access capital to enable them to grow and develop and continue to export in particular. So this is where we see our market playing in this space, like I said, complementary to these other sources of capital. The other benefits to our markets, of course, are it's a more regulated environment, as well as, of course, being more liquid. In terms of timetable for that, this has been going on for some time to get to this point. So we're now in the build phase. We've just completed consultation with the industry on it. It was open for public consultation, but we selected some particular industry players where we sought their feedback as well. We received probably close to about 30 submissions from industry players that represented broking community, legal fraternity, both representatives from the venture capital area, industry bodies, independent directors, smaller issuers, prospective issuers, existing issuers. So we actually had very, very good feedback in terms of breadth in our proposals for that market. Fundamentally, I think it's fair to say people are excited or supportive of the market, although we did get some consistent feedback as well, which we're looking at the moment. So I would expect that we will make some refinements to our original proposals based on that feedback. But I think overwhelming theme from people who participate in this market are supportive of the concept and the ideas for it. So we're excited about that. In terms of next steps for it, we'll be applying to the Minister, we've already applied to Minister for the exemptions necessary under changes to disclosure. We then need to apply to the FMA to approve the rules for this market and to approve the market itself, and we'd expect to be able to do that in the next couple of weeks based on our review of the feedback we've been getting. From a technology point of view for the new market, very, very comfortable where we're at, more than in terms of the trading environment set up, new website set up, etc. So we expect to be able to launch pending regulatory approval and ministerial approval, and of course companies who want to issue by the middle of the year. Very quick one, this just gives you a case study of if someone was back at the smaller stage here, moving up to the main board to actually demonstrate what they've done. So this is A2 actually doing the stepping stones over the last 4 years. The green box here is where they moved up from the AX up to the main board. This mark here being their market cap, this line. So they've gone from down here less than 100 million up to over $500 million during that period. Our fee has gone from about 20 grand a year up to about 90 grand a year. So good improvement for us. Once again, reiterating that our interests are aligned with our issuers in this case, but they've had a market cap increase of over 500% in that time. So this is what we'll try to emulate with our growth markets going forward. Equity derivatives is probably the next major part of our area of focus at the moment, in that we see this as rounding out the exchange infrastructure here in New Zealand. It has underlying benefits to the rest of the market by having it. However, in launching it, we think this is going to be a slow burn. We expect to see very little revenue benefit from launching equity derivatives in the short term. However, we think the companies that benefit, we think fund managers will benefit from it. We think eventually even retail investors will benefit from it, and from a liquidity point of view, underlying stocks will benefit from equity derivatives being launched and being traded by the market. In terms of where we're at now, we're very, very close to being able to launch this. It's been a difficult process because what we've had to do is get a new clearer on board, which has required us to cost share that or put some money towards them coming on board as a clearer. We've had to test it now with the participants and the clearer. That's been done, and we're really just waiting now the final participant sign off to launch it. So this is very, very close. What the chart here is showing you is really some comparisons of other markets around what their ratio of derivatives trading is to their cash markets. So Mexico here is at about 20%, and that's what we'll be aiming for. We think this is a conservative estimate. We'll be aiming for derivatives turnover in 5 years' time of about 20% of the cash market. Now, Tim talked about before around what are some of these 10x opportunities. This is one of them. So 5 years to the point to get that ends up at about $2 million in revenue in 5 years' time if we get to that 20% turnover. But if you look at the ASX, that's 10 times that amount in terms of derivatives trading volume. Work at the moment all on just getting it launched. Nearly there, but going forward our focus then will be on actually increasing the participants in this, increasing the value of it to the market, and on the back of that what we should see is increasing turnover and obviously increasing liquidity benefits and revenue to us. This sort of just gives you, if you like, the value chain of the capital markets from left to right. Distribution is not an area we play in, but we tend to have some, don't worry, we're not going there either, Jeff, sorry, at the moment. The rest of its areas that we do have a role to play in here. And we see the fund management industry will probably grow quicker than the equity market. We expect that's definitely the case, but we're a downstream beneficiaries of this through the rest of it. So this really just shows you where, if you look at this chart, some of the things I've talked about as priorities. Talked about in the moment Smart Shares, which is our passive funds management business. We've talked about information, and we've talked about markets in regards to the new growth market. So where these other opportunities here is there's 2 clearers in New Zealand. That's something we'll explore to see whether or not there's ways of collaborating to make that more efficient, and also working with the trust companies, which is down here in custody, to see whether we make more stock available for stock lending. What this chart's showing you is passive funds management here in New Zealand. The yellow line is our ETS business as a percentage of all managed funds. The blue line is US passive funds, and the grey line down here is Australian ones. So you can see if we compare ourselves against there, as everyone else is trending upwards and we're trending downwards, despite us being actually one of the very early adopters of passive funds management in New Zealand. So a couple of reasons why we see that possibly the case. With the small market, historically it's been here, it's relatively easy to track the index because it was largely telecom, so the benefits of a passive index fund were not necessarily here. But also I think it'd be fair to say our fee structure in that particular product probably has hampered its growth as well. So that's something we're going to look at this year. In terms of our plans for it, we've got some remediation plans to do from just a legal point of view in clearing up the master trust deed. In doing that, we're going to resolve some risk areas, but also it'll make us easier to launch new ETFs afterwards. That's something we'll be looking at doing. We'll be looking at reviewing the fee structure in terms of increasing the product attractiveness, some website work I mentioned before, but we'll also look at doing more marketing of this product. I don't think we market this product particularly well. I think it's a fantastic product, the Smart Shares ETFs, from an investment point of view and experience of it in Australia. So I'm surprised that we don't see more of an uptake in it here. So this is something we'll definitely be spending some time to see if we increase our FUM in this particular business. Part of that will be including launching some new ETFs, which we expect to do this year. We'd also be open, nothing on the table immediately, but also be open to acquisitions to create scale in this space as well. I'm on the home stretch. So dairy derivatives, and this chart here, all it's showing in terms of the yellow part here is dairy exports in terms of volume. The blue line is the Fonterra milk price. And as you can see, as volumes are increasing and sort of post 2007-8, we've seen a market increase in price volatility. And you're actually even seeing that now if you continue to watch GDT. So the reasons for originally launching dairy futures have not changed in the last period. In fact, the reasons for having it are actually getting more and more significant as volatility is actually staying, it's not going anywhere. And that volatility is obviously affecting firms' ability to deploy their capital. So they're looking at ways of hedging their risk. This is, and I'm talking about here, both processors and consumers of dairy globally. The market for here, originally when we launched dairy futures here, we expected probably the market largely, or at least have a large contingent of farmer participation here in New Zealand. And what we've found actually is that's really not the case at all. It's largely institutionally driven, one by Fonterra managing their risk, but equally offshore clients trading this as well. What we're seeing actually now is separate to this completely is Fonterra really offering essentially a dairy future via the guaranteed milk price, separate to this. So farmers are actually getting the benefits of sort of the futures, if you like, but Fonterra are actually doing it for their shareholders rather than farmers doing it directly in this market. In terms of the growth since 2010, this has grown at about 50% year on year in terms of volume, and we expect that to continue to be the case this year. Big move this year, Tim talked about before, was approval from the CFTC, the Commodities Futures Trading Commission in the US. What that gives us is the possibility of more clearers and traders from the US trading. It removes a hurdle. It was possible for them before to do it, but it was just a significant hurdle for them to overcome, which has now been removed. Catherine, who's the head of our derivatives business, was there 2 weeks ago meeting, and it's fair to say there's renewed interest on the back of that CFTC approval, first country, first exchange in the world to get it. We think we'll see renewed interest of trading dairy derivatives out of the US in particular. We're also seeing more interest out of China and Greater Asia from customers who want to trade these. So, but nonetheless, at this stage, still from a revenue point of view, this is still not big numbers, but it's one of these things Tim uses again of like a 10x type thing. Marginal cost zero as this dials up until it gets really significant when we've got capital adequacy to care about. But in terms of growing at 50% year on year, if we can continue that, little to no cost impacts of doing that. So the base level costs are baked in. So we're very keen on growing this. We think the market needs it. We think we're well placed here in New Zealand to provide it as the largest dairy exporter in the world. We think our home market, that gives us a competitive advantage in launching our dairy derivatives business. So that's for my section. Full agenda, as you can see, for this year, and I'll sort of focus on this year to give you a flavour of what we're working on at the moment, but our plans extend past this year. Our roadmaps extend out to the next 3 years, but it gives you an idea of what we're going on, but also just be cognizant of our roadmap and plans are well baked in for next year and beyond as well. So thank you for listening.